Hi there, welcome or welcome back. Today we're going to talk about your money. Is it protected or not? Well, it depends on where you have your money. If you have your money in a bank, your money is insured for up to $250,000 per depositor by the FDIC. Now, if you're at a credit union, similarly, $250,000, which is by the NCUA, which is the National Credit Union Administration. So if you do have that, total among all your accounts, then yes, that would be protected. Now, in the event that the bank fails, like in a recession or something like that, um, then you should be covered. However, if the bank doesn't have enough money to cover all the depositors' assets, then they would be forced to sell assets to cover that. But chances are, if the bank is in financial hot water, ooh, I see that being very iffy. But for the most part, if you do have up to 250,000, then you would be covered. Now, if you have money in the stock market, that's a completely different story. Now, the stocks are not insured, so I'm sure you potentially have seen before where they have this blurb that past performance is not an indicator of future performance, and that's pretty much it with the stock market, because a particular stock have been performing well for the last 10, 20 years doesn't mean that in the future it will continue to do so. So there's no insurance, so you have to know that if you do invest in the stock market, there is a chance of loss. Now, over time, there's definitely a benefit to investing in the stock market, but you have to know what your risk tolerance is and then what timeline you're investing for. Now, if you do need your money in the short term, it may not be a good idea to put it in the stock market. You're probably better off putting it in a bank as far as, CDs, money market, or something like that, or invest in something that's low risk. Now, knowing your risk tolerance is also important, because if the stock market goes down 2% or 10% in one day, and that is giving you high blood pressure and you can't focus, now that may mean that your risk tolerance is not very high. So you want to keep your investments in lower risk type of products. Now, if you don't need your money anytime soon, let's say you're 20, definitely would be a good idea to invest in those higher risk, mid cap or ETFs or individual stocks that are perceived to be maybe gonna increase significantly over time. And plus, you don't need the money right away. Now, if you do invest in the higher risk stock, of course, there's potential for loss because the market does fluctuate over time. So if you do happen to need the money in one of those dips, then you could potentially lose money. But over time, you are going to show an appreciation in the money that you do have in the stock market. So keep in mind that if you do want your money in the short term, the stock market may not be the best idea, but you could also still do that knowing that you do need that money and keep your risk or exposure a little bit lower, to keep you from having major losses on the funds that you do have invested. Hopefully, this was helpful. And if you have questions, comments, drop them down below.